IPOs are a pretty sure shot way of making money, especially if they are small and medium enterprise IPOs. Look at the recent SME IPOs. If you think this way, you're in for a shock because IPOs in general come with a very well kept secret which stacks the odds heavily against you. There are risks here that most people have no idea about. You wouldn't be wrong. 166 of the 240 IPOs that happened last year gave a minimum of 50% in returns, and 67 of these 240 gave at least 100% returns. So what's the issue with spamming IPO applications and making a quick buck? I'll tell you exactly what with the help of data. In the last year, India saw 91 mainline IPOs and a whopping 240 SME IPOs. But the shocking part unravels itself when you see the value of these issues. The larger IPOs collectively raised 1.6 lakh crore. That's about 1758 crore on average for each IPO. But if you look at the same number for SME IPOs, they only raised 8,750 crores cumulatively, meaning each IPO averaged at 36 crore rupees. So what do these numbers mean? Long story short, insane amounts of risk and potential losses for you and me as IPO investors. Let me explain. My name is Aaditya Iyengar, CFA. Welcome to Personal Finance TV. And today we understand the lesser known realities behind the craze of SME IPOs in India. Now, if you look at the SME IPO performance we just described, after the first day's closing, 72 of these IPOs are below their listing day closing prices, with losses reaching up to 75%. Look at Varia Creations for example. The IPO was 80% up on listing day, but now it's almost 77% lower than its all-time high. And there's concrete data as well as some basic logic which would tell you that IPOs have way more risk than you think. Let's start with the data. The liquidity and profits for SME IPOs were highest on listing day and consistently fell ever since. SEBI studied some IPOs which showed more than 70% of these investors sold their IPO shares in less than 1 year of listing. And the crazy part is that the data looked like this only for the IPOs with listing gains. Investors on average preferred holding on to the IPO shares of companies which posted no listing gains, showing a strong tendency of investors to purely invest in IPOs for short-term gains. Gains that are based on hype and not actual company fundamentals. Many IPOs as a consequence have an initial peak and then a steep drop followed by a downtrend. Now wait, more on this trend later, but the point is when this craze spills over to SME IPOs in particular, the results can be disastrous. Most of these gains that we are seeing are purely hype driven. Look at the case for Resourceful Automobile Limited. They run bike dealerships in the country. They don't even manufacture any bikes. This company tried to raise 12 crore rupees from the SME IPO market and they got bids of 5,000 crore rupees. This type of irrational demand drives up the stock price to astronomical valuations. And given how small this issue is, it does not take long for the stock to fall if a major figure such as the company's founder dumps his stake. And guess what? For most IPOs, not just SME IPOs, the founders almost always exit their position sooner or later. And there's a very messed up malpractice happening here which would shock you. Now, back in the day, the motivations to do an IPO were very straightforward. It was to get access to capital to expand your business when it was either not feasible or not preferred to seek out a bank loan. But now, some company promoters are looking to do an IPO purely with the intention of making money. SME IPOs, for example, are priced extremely high and the hype is being exploited such that the promoters are able to sell their stake at extremely high valuations. Valuations that the fundamentals of the company may not be able to justify. The IPO is marketed as the next big thing and the valuation is set at a premium only to get maximum gains for the founders and the banks involved. The MD of Bexley Advisors, a small investment bank, went on record to say that the post-IPO performance is a big factor when it comes to deciding the IPO price. The investment banks involved are trying their best to inflate this IPO so the founders can make maximum gains. And it makes sense when you think about it this way from the founder's perspective. Let's say you have a house which is valued at 1 crore rupees by an independent appraiser. When you go out to sell it, do you list it at 1 crore? Obviously not. You list it at least 1.5 crores so that after negotiations, transaction costs, taxes, you would end up with at least 1.1 to 1.2 crores. And from this point on, if that buyer decides to sell this house to someone else and discovers that it's only worth 1 crore rupees, how's that your problem? Human tendency, isn't it? That's pretty much what's happening with certain IPOs. Look at the trends. Remember I said the average size of an SME IPO was just 36 crore rupees? What that means is there's very few shares for a lot of people, which leads to huge demand and extremely tiny supply. And as a result, causes the volatility of the stock to spike. Let's look at Varanium Cloud for example. This company got listed, then it saw its stock price surge from 40 rupees to 373 rupees only to fall to 15 rupees. Rachna Infrastructure jumped nearly 8x from 185 to 1250 only to fall more than 90% to 84 rupees. And now let's look at the 3-year charts for all these companies. The price jumped to the all-time high in less than 4 months but has been on a forever downtrend since that point on for the next 2 years and 8 months. An almost 90-degree peak and then a huge drop followed by a downtrend where everyone made losses. And you know what investors don't seem to realize? This risk isn't worth it, especially when you quantify it. When it comes to SME IPOs, you have the likelihood of losing 70 to 80% of your initial investment, and the investment size isn't the same as regular IPOs. For most investors, SME IPOs are a substantial amount, where the bid size is nearly 10 times more than mainline IPOs. If you do get an allotment, you would be shelling out 1 to 1.5 lakh rupees per issue compared to the 15,000 rupees of mainline IPOs. And it's very easy to say this. If most IPOs end up in profits on listing day, then I'll just sell it on that day. But behavioral psychology would say otherwise. Who's to say that you would not want to hold when you see the 100% gains on listing day? And when the price falls by 20%, most people don't sell and take the gain that they have. Instead, they say, let me wait it out. The price may rise again. And this is seen in the IPOs that made losses. The SEBI study proved that there was heavy loss aversion here. Investors were reluctant to sell and cut their losses, even if it meant seeing smaller losses by exiting early. Instead, you need to understand that SME IPOs have a lot of risks, not only with respect to the way they are structured, but due to the high demand and volatility. And of course, the fact that these are very small companies without a tried and tested business model that could withstand any environment. This is very similar to investing your money in your close friend's small business. The chance of failing is very real. The only takeaway here is that invest basis the business's fundamentals and the valuation. Meaning, SME IPOs that have the potential to be buy and hold investments for years to come instead of hyped up sources of making a quick profit. Which SME IPOs have you invested in lately? Let us know in the comments. And if you learned something new, consider leaving a like and subscribing to Personal Finance TV. I'll see you next time.